Hi Aseem bhai, welcome to the Sensei Kujaku show. Thank you so much for coming on.
Thank you for having me, Krish.
So Aseem bhai, it's funny when I look at SBFC, the company that you and your team have built. It's easy to forget that it's actually such a young company, and as you described it, a small startup. When you look at the numbers, it's market cap at about 9,000 crores, revenue touching 1,000 crores. Profitability at about 200 crores and AUM of about 6,500 crores. I mean, these are incredible numbers. Before we get into, actually running the business and lessons you've learned over time, what is your core emotion and feeling when you look back at these 7 years and how far the company's come in that time?
So, as Buddha says, everything in life begins with intention. And what is the intention behind doing any activity is the defining feature of all outcomes. So the intention and the reason why we started SBFC was there was an intention to build an institution. When we once thought that when we are retired 80, sitting on a park bench, we don't want our grandchildren to accuse us of wasting oxygen. So, is it possible to build something? It would take 20 years to hopefully build what is the starting of an institution. It would take much longer to actually complete it, so I would definitely not be around to see it. But can you start an institution that eventually does 3-4 things? One is that what this country really needs is creating jobs. And if you can create an institution that creates jobs, builds lives, and affects people over time, you're doing something good. The second is that every business has a right to stay in society. It has to win the right to stay in society. And it has to do something that really benefits multiple amounts of people. So whatever you do, is it socially good? Is it socially relevant? Are you doing something which is a value add to the nation? And are you serving a populace that needs that particular kind of product or service? Then you have a right to win over long periods of time. And third is that whatever you are building, does it have a long moat? Where you can keep and a long runway where you can keep building it over a lifetime and yet not get tired of it. Finance is one such field that lends itself to such a proposition. So we believe that if you are able to build something material, meaningful and good, it would be a lot of fun in the process. So when I now look back at 7 years, we can say that we have made a beginning. We have made a beginning, and so far so good. And as they say, well begun is half done. So hopefully, we will keep on this path. There are going to be many storms, coming our way. Hopefully, we'll stay our path, and let's see where we take it.
And do you think, in hindsight, you've made a critical error as a startup in making money? Do you think your market cap would be twice what it is if you were making losses?
One of the things is that earlier when we used to start something, it was called starting a business. This word startup is a new invention that has just come in of recent times. Unfortunately, people have got confused, and thinking that startups means burning money, when spending on all this. I don't even understand those terms, CAC and etc. But the reality is that every business, if it has to have a right to win and stay and be relevant, it has to be profitable. The one purpose of business, the central purpose of business, is to make money. So while you want to do good, in the long run win, but in the short run also you need to win. And when you're building a business, you have one eye on the microscope and one eye on the telescope. So it is important to get both the quarter right and the decade right. You cannot say that I will make a mess of my quarters, but eventually I'll get the decade right. And I don't think that works, which is why we never called ourselves a startup. We stayed away from calling ourselves a startup or a fintech or any of these cool acronyms that are used, because we believe that there is only one narrow pathway to heaven and several beautiful highways to hell. So we would rather stay on that one narrow heaven pathway, and profit is ultimately the score by which you measure everything.
My guest today on the Sensei Kujaku show is Aseem Dhru, the founder of SBFC Finance, an NBFC focused on MSME lending and gold loans. Aseem built his career over 2 decades at HDFC Bank, building out various businesses within that company and the group as a whole. SBFC Finance was founded in 2017, and over the subsequent 7 years has become one of the most exciting and well thought of NBFCs in the space in India. I'm really excited to have Aseem on the show, and I hope you enjoy our conversation as much as I did. Aseem bhai, that's actually a fantastic segue into the topic the primary topic of today's discussion, which is the joy of building, which mildly interestingly is an acronym for job. But I want to start by highlighting what it is that I want to talk to you about primarily, which is the joy, the satisfaction that comes with actually sort of building something yourself, even when there isn't necessarily a reason to do so. There may not be a financial need to do it, but still there is something beyond material gain that propels us to build things. So I want to start by talking about your thought process when you were deciding or contemplating building a company of your own, and how you thought about that, and what was your incentive or motivation to do that.
What happens is that life is a continuum with an end that suddenly happens. So there is no defined purpose to this existence, and we human beings have all through time sought ways in which they wanted to give some meaning to their life, and it shouldn't look that the whole thing had no point at all. And somewhere when you in the search for meaning, you at various points of time of existence, the Maslow's hierarchy of need comes in, and you start with basically taking care of yourself first, and then you take care of the family, and then you take care of your whatever old age and stuff like that, nest egg you build. And once you achieve those basic parameters, there is still a want. And then the human life is such that as the masters say, हमने जाके देख लिया है हद्दे नज़र से आगे भी, राह गुज़र ही राह गुज़र है, राह गुज़र के आगे भी. So in life there is no finish point. You just as you go, there is another road, another mountain, another journey beyond that beckons. And human beings like to be challenged. We like to be put ourselves into situations of pulling on the impossible, the improbable, driving ourselves to the edge. There is joy in it. And ultimately, if you see, there are two things money does. Money can either buy things or it can buy experiences. Both are wonderful things. Initially you will always buy things with money. At the second stage, you will buy experience with money. Then you realize the futility of both. But until you have experienced them, you may not realize it. But in the end, you will realize the futility of both. And then your mind is still searching that what is it that will give me joy beyond this. And you ultimately come to the conclusion that really what gives us joy is creation. Whatever we create, an artist paints, a musician composes, you may choose your profession, whatever it is, but creating something. If you can build a company, go build a company. If you can build a startup, go build a startup. You do whatever that gives you joy. I mean, while you're doing this podcast, it is you are creating content that is consumed by people and hopefully benefiting somebody. So somewhere there is an urge to create something that is inherent in all of us. And at some stage in life, you have the ability to actually take the plunge. And when you are taking that plunge, you are always nervous, you're always scared, and it depends. See, there are two kinds of people in the world. Those who are confident of themselves, and those who come from a point of fear. Personally, I have always lived my life from a point of fear. I've always thought that there are people way smarter than me, there are people way ahead than me, and I may not be able to rise up to that level and of competence and be able to deliver to that level. So somewhere that fear was a big motivator. It was a big drive through my life, right from my school days onwards. That fear of failure and that innate desire not to fail. So somewhere you are torn between these two things, that you hate failure, you don't want to fail, but you are constantly worried that you may. And that brings out the best in me, and in some sense, and that's what motivates me to do this. So the reason of doing this is to create something, to build something, and look at the joy that there is nothing. One day, 7 years back, Mahesh Dani and I were sitting on a Excel sheet, and it was 1 a.m. in the night, and the cafe in which we were doing it had shut down, and we were sitting outside in the footpath, and looking at an Excel sheet. We had no name for the company, so we used to call it a small business finance company project. And ultimately, that when we formed the company, that SBFC became an acronym of a small business finance company, because we couldn't think of anything more creative than that, and that's how SBFC came into existence. So a company that was just there in 2 Excel sheets is now out there in 250 locations across 16 states, 3,500 employees. So when every day when you go to office, it is okay. Now what next? What more can we do? Where do we take it from here? That's a kick.
Yeah. And is there something magical about those early days? Like you said, you're sitting on a footpath somewhere at 1 a.m, and it seems like something that should trouble you, but actually there's something phenomenally exciting about things like that.
So what happens is that every story starts small. It starts sketchy, and nobody can see the full 18-hole golf course. When you're playing golf, you also see one hole at a time. You play one hole at a time, and then you go from one to another. So what happens is that when you are building something, it begins with an idea, and ideas on an Excel sheet, no company fails. Every company has a phenomenal future on an Excel sheet. The difficult part is to bring that Excel to life. And at that start of the journey that everything is going to be way tougher than anything you have done so far. Because whatever you've done so far, you are part of a brand, you are part of an umbrella. And that brand was so powerful that when you gave the visiting card, your sales, half the sales call was done by the visiting card. You just happened to be the monkey carrying it. So, but when you're on your own, everything begins with a no. When you go ask for capital, most people are going to turn you down. When you go ask for debt, most people are going to turn you down. When you want people to join, good talent is going to turn you down. Why would somebody want to give up their good jobs and join something which may or may not work? So everything begins with a no. And it's a long process. Entrepreneurship is a long process of converting every no into a yes.
Yeah. It's fascinating when I see people like yourself who are, have had a very successful track record doing something and then decide to either it's a second attempt at entrepreneurship, or it's they've done worked at a larger company and then start their own thing. And I compare people like you to, people who are say like 22 years old and think that unless they make a unicorn within 2 years, they failed and life has passed them by. And you were talking about, everything is a no. But what do you think, everything's a no at the start, but what do you think have been the advantages of being an entrepreneur and starting an organization in your 40s when you've already learned so much over the years?
If you see, what typically happens is that more innovation is done by the younger setups. So the younger entrepreneurs sometimes come up with extremely innovative things, so because they do not have the baggage of experience. The older startups, have the baggage of experience, but they also have an advantage of experience. So when they start something, they will cover their base a little better than what the younger setups will do, and their probability of failure is lesser. A younger startup's probability of failure is much higher, but the probability of phenomenal success also is much higher. So the older startup may not have a huge risk of failure, but will also not have a huge upside gain as well. It will be more a steady ship, in that sense, because that's how you'll cover your base and play the game. In two sense, startups work when you are pushing the boundaries of something. So the younger startups, today, for example, it would have been almost impossible for a senior banker to have done what a Paytm did. It would almost be impossible for a senior restaurant manager to have done what a Zomato did. So sometimes the advantage of younger startups in innovation is extremely high, but they often get the rest of running the company not that right. So sometimes errors are made, and it's a trial and error method. So I think both have their advantages. In traditional businesses, which are more like finance, where regulatory concerns are high, where the ability to manage the environment, is very needed. There, the older startups have an advantage. But in pure technology-driven pieces, the younger startups are hugely ahead.
Right. And I'm going to take you back to, it's tough to say the early days because it's still the early days of SBFC. But the apps, initial, say 1, 2, 3 years. How exciting was it for you personally to sort of be back in the trenches in a sense and getting your hands dirty, building an organization from scratch? It was, hiring the first employees, opening the first branches. How was that experience?
I wish you never come out of that experience because that is the absolute high. The joy that you get in doing these little things, the first time is of a different level. The first 1 crore of loan you do, I mean, in your past life, you may have been doing thousands of crores of loans in a day. But that 1 crore loan that you touch, that the first loan that you disburse, the first file that comes in and you physically look at it, setting up the whole technology, infrastructure, setting up the whole operational processes, setting up the workflow engines, building technology capabilities at the back end, the stacks there, integrating it with about 200 odd APIs. It is phenomenal. There are two things. One is that you always wonder if you are doing it enough and if you are missing something, because there's nobody, unlike in a job, there's nobody here to tell you what you are missing. There's nobody really telling you what you need to do. Also, nobody tells you at what pace you need to move. So you decide the pace at which the organization needs to move, and that is a hell of a lot of responsibility on any individual. But the thing is that first you are battling with your own emotions. You are going through your own. There'll be some days where you are everything is going your way and you are feeling very confident. There are some days where you're feeling a little diffident, because some things have turned against you. There are some times, you are in an expansive mood. Sometimes you are more in an introspective mood. And generally, in whether it's a stock market or whether it is in building any business, emotions and intellect, conflict. And if you let emotions win, you lose the game. If you let your intellect, win, then you have a better probability of winning the game. So to manage your emotions, while you're going through everything, because see, it's like this, that you are initial days, you're just selling a story. There is nothing on paper. It's all what. So you go to an investor, give him a two Excel spreadsheets, and say that, here, I want $100 million in exchange for this. If you give me this, I can build this. It's just a leap of faith at the end. Whatever math they do, it's a leap of faith, that they will make, at all. When you go with that kind of a spreadsheet, obviously, 9 out of 10 are going to laugh at you and turn you down, because the odds are against any business that starts. The odds are 90% businesses will fail. 10% of businesses may work. Of that 10%, 1% may really become successful. So the odds are really that 1% game. And if you ask for $100 million to play that odds, you won't be surprised if people say no. But from there to making people join, because when somebody is leaving a job and coming over, how do you sell the story in terms of what is it that you want to build and why should every individual become a part of the story? So what was really critical in those days is that we are not playing a tennis match, in which a great player can determine the outcome. We are playing a football match in which all 11 players have to be world class. So unless we have all the 11 players, on the field world class, because unless you have your midfield right, unless you have your goal key right, unless you have your defense right, you're not going to win the game. There'll be holes, that somebody will see through. So it is important that you get all these people right. So getting all the people in, it is important also that it may start with a founder. It may start with a couple of founders, but then you need to have more than 2 founders. You need to have 10 founders. You need to have 11 founders. You need to have 20 founders. So we, like that, have a list of 110 people across the country who are like founders, who think hopefully exactly like how we are thinking. And it is everyone's company. The company doesn't belong to an individual. It is everyone's company. And ultimately, there are 3 things, that drive performance. So there's this book called Drive, in which Daniel Pink, says it very well, that there are 3 things that drive performance. There is autonomy, mastery, and purpose. So what is important is that the team, should be. There are 2 kinds of motivation: extrinsic motivation and intrinsic motivation. Extrinsic motivation in terms of incentives, stock options, bonus, don't take you too far. Intrinsic motivation is what really drives human behavior. So how do you get all the people intrinsically motivated and as passionate to build something and give their next 20 years of their life to build something material? So one is it becomes everyone's objective, not one person's objective. The other is mastery, that you need people who have mastery over their subjects. So getting everybody in the team who's a master of the game. For example, Pankaj is a fantastic risk manager. We have Narayan is a fabulous CFO, that we have along the game. Ganesh is a fantastic technology guy. VM is a beautiful ops guy. Sai does a wonderful job of collections. youngest member of our team, Sanket, does a wonderful job of strategy and investor relations. So you need a lot of people, and I cannot name all 110, but you need a lot of people to really build something material and world class. The third thing is purpose. That everyone should have alignment to the purpose of what we are doing. So if you've got all these three things right, it is you are on your way. Uh, it's a journey. It's fun. We have made mistakes. We have skidded. We have slipped. We have had several accidents along the way. We have had several death moments, near death moments, because it was not easy. And when we started the business and the storms that we were about to face, if we had known that, we would have never started. So sometimes it's good God doesn't tell you the problems. Then once you're in it, you have no choice but to go through it.
Right.
As Churchill said, if you're going through hell, keep going.
Exactly, and it's such a common thing of story among many of the most successful companies in the world, that how often they were at the edge, right? They were on the edge of a cliff, and it's some small thing that kept them on, and luckily it did, because eventually they turned into fantastic companies and organizations. But I want to talk about something specific that you were talking about. As you're saying that it's a team and all 11 have to contribute and do their job. So I want to talk about how you control the quality of people that join your organization. See, it's one thing when it's a first 5 hires, 10 hires, 20 hires. You can have very strict controls and you yourself are hiring them. So you can say, okay, I want to hire the stars. But when you scale to 500 employees, 1,000, 2,000, 3,000, 10,000, it's tough to A, find so many people of that caliber, and B, make sure that everyone who gets hired is of that caliber. So what have you learned over the years about ensuring the right people join the organization even at scale?
So this is a trick I learned at HDFC Bank, where it was the Napoleonic thinking that it's the generals that win or lose battles. There is no such thing as a bad soldier. So on that principle, I saw HDFC Bank being built. That they had absolutely fantastic senior management that came in at the start of the bank, and then they took rookies like us, who had no experience. Like I was all of 24. And I was asked by Mr. Puri to start retail assets for the bank. Who would do that? I had no prior experience, I just freshly minted CA, no prior experience, never did retail before, didn't have no understanding of what I'm doing, didn't know how to read agreements, didn't know how to read covenants, didn't know how to build risk models. And in those day and age where there was no data available on customers to start with, there was no income tax returns being filed, there were hardly any bank accounts there, there was no CIBIL score equivalent there. So in those day and age, we figured out a way to build retail lending models. So I think good culture is built by a great senior management team which you handpick, and then you take people who are fresh, and mold them into the culture of the organization. So it's a constant process, because culture is not what you can put people in a classroom and lecture on. It is what they see and do on a daily basis. The behavior that they see is the behavior that they will imbibe. The behavior they see being rewarded is the behavior that they will demonstrate, and the behavior they see being punished is the behavior they will avoid. So ultimately, it is about getting everyone in line, when the point is that in leadership, you lead with a strong mind but a soft heart, and both of it is equally important if you are to really connect to people down the line, where they see that there is a strong mind behind what is being done, but there's also a soft heart, that you're not become so cold and so mathematical that you're only being driven by numbers, because ultimately every business, even the business of numbers, is about managing people. So in a sense, connecting to individuals, and every individual understands a different way of expression. Everybody is driven by different things. Some people are emotional, and they need to be handled differently. Their emotions need to be respected and appreciated. If they get hurt, their heart goes out of the business. There are some people who are driven by incentives and rewards, and that's all that matters to them. They need to be driven accordingly. And there are some people who want to grow in their career. Their knowledge is their passion. So you need to give them jobs that keeps them interested, in doing pursuing knowledge, and they think they are gaining every day, or they will get disillusioned. So understanding individuals, and tailoring your style to each individual, is important along the journey, or you lose people, because if you want to win, you need to win. The game is won when every player plays with his head and his heart. If one of it is missing, the outcomes will be suboptimal.
And what if you, how much of your job would you say is man management, dealing with, sometimes it could be egos, sometimes it could be conflict, it could be anything. How much of your job, how much of your time is spent on things like that?
What happens is that every CEO has ultimately 2-3 responsibilities along the way. The first is to get the right people in the right position. The second is to get out of the way, and the third, it is like a gardener. The gardener plants the right fruits, the right vegetables, the right flowers, the right grass, in the right place, and then he has to water, and he has to ensure that he is taking care, but he can't pull the crop out. The crop will grow at its own pace, So as Kabir Das says, "Mali siiche so ghada, rut aaye phal hoye." So it will take its time, for the flowers, and the fruits to happen. But your job then is to keep the weeds out. That is a very important job of the leader, to keep the weeds out. And weeds will come into any garden. And it is the basic law of entropy, that any, the third law, second law of thermodynamics, that, any system goes towards disarray. And your job is to postpone that disarray as much as possible. You will never be able to kill it, but you postpone that disarray as much as possible. So it is important to watch for weeds, and early signs of issues in the organization, and take it head on. Whether it is issues between people, whether it is issues between aspirations, whether it is issues at the market level, or issues at a business level. Various challenges will come at various points of time, and you have to have the ability to navigate these challenges. So if you are keeping the weeds out, the final thing is that your job is to is two things. One is, I am responsible for everything that is going wrong at SBFC. That's my accountability. Everything that's going right, the team is doing. Because in reality, I'm really not doing anything. They are doing what they are doing, and I'm just reporting the numbers and the nice guy who gets the credit for it. But the everything that is not happening, which most people don't see outside, or they are kind enough not to point it out. But I'm responsible and accountable for all those things that did not happen. So when I look at my own scorecard and I make my own appraisals at the end of the year, probably the guy with the least amount of achievements, and the highest amount of failures is me. So that is one part. The second, is a little unfortunate that your job becomes, every CEO in this country is a chief follow-up officer. So he half his time he's just following up on work getting done. So if we have discussed something, we agreed on something, but unfortunately one of the Indian traits is that we like to do everything at the last minute. And when you do things at the last minute, quality will always be a compromise. So one of the frustrations, when I speak to other CEOs also, it's a similar thing, that the job is to follow up, to get things done. And the third job is to look ahead and beyond the immediate. Because the immediate is where everybody's focus is, everybody's attention, there's a budget, there's a plan that's being executed. But you may be, if you have got the long-term direction wrong, then a great execution only is going to make things further back. So when you go wrong on strategy, when you go wrong on direction, when you read the tea leaves wrong, whether interest rates are going to go up, down, whether you see credit cycles, weakening, strengthening, what kind of a loan growth should you take, what kind of business you want to get into or not get into, what kind of business you want to get out of. So the ability to really look into the future, and predict what you need to do today and change behavior today. So it is that ultimately, that if Titanic sunk, the captain didn't see the iceberg. He should have, got the ship right. So that you live with that constant, understanding that if SBFC succeeds, it succeeds because 3,500 people. If it fails, it's just because of me.
Well, I appreciate the candor, and I'm going to talk about that in a bit. But I want to talk about the hyper focus that I see at SBFC in terms of where you want to play and everything else that you want to, at least for the foreseeable future, stay away from. And the obvious focus, as the name itself would suggest, has been lending to, sole proprietorship, small businesses, MSMEs as we think of them generally, and gold loans. And there's an unsecured part that's sort of on its way out. But so basically, the first two are the areas that you focus on. Can you explain why you thought it's important that as an organization you have that kind of hyper focus and are not distracted by other things that could also be an opportunity, but it's important to focus on where you think you have the greatest strength?
I have looked at NBFCs from 1990, and I saw the history before starting SBFC. I saw the history of NBFCs from 1990 onwards, and what came across very very clear is two three things. One is that NBFCs that focused on a particular area rather than being general purpose have generally done better than those who were all focused. So it is easier to get one thing right. It is very difficult to get many things right. It is tough enough to get one thing right, but it's comparatively easier. The second is that NBFCs by definition is a business model which is a little strange model. You are borrowing from a bank and lending to the customer of a bank. So logically, why should you even be existing? So your model has a weakness that you have to accept. So what is your right to win? Your right to win is by identifying a segment which is in the rain shadow of a big bank. Because you cannot head-on compete with a big bank. You will have adverse selection, and you will have an adverse outcome. So you have to find a business which is in the rain shadow of a large bank, and in that business you have to have the mastery, because it's a winner-take-it-all model. Every NBFC in its segment, you will see that it is the market leader in its segment, and it gets disproportionate value creation because it is the market leader. The second guy, is actually 1/3 of that value. So to that extent, that whatever is your segment, you need to ultimately win that segment if you want to create long-term value for all the stakeholders. The second piece is that banking is a business of scale, and NBFC is a business of efficiency. So it is important that you understand that because your business model, you are a coolie of credit. You are borrowing from a bank and lending to and parceling that credit out in small pieces to small businesses across the country. So it is extremely important that you are able to execute this at the lowest possible cost. So as an NBFC, our only job is to manage three costs: cost of funds, cost of credit, and cost of operations. The rest is mere details. If you are able to manage these three costs right, you are home and dry. If you do not manage these three costs right, whatever else you do is multiplied by zero. So it's and it's easier to first become the king of one market. Once you achieve that, then there are multiple products that you can add. But first, as an organization, see, for the first 10 years, your job is to not die. When you start up, your basic job is that I want to be, so they said after 5 years, what is your ambition? I want to be around there. That was the first ambition. After 5 years, SBFC should still be there and should be still around, because many things have gone either way. So it's important that you keep that in mind, that unless you master one thing, you cannot say that you're going to master everything at once.
And in your study of NBFCs over the years, and even in your own sort of experiences and what you yourself have seen, what do you think has been a primary cause for the failures in NBFCs?
So NBFCs have failed only for two reasons. They have failed either at their own folly, or they have failed because of a fraud. There are only two reasons why NBFCs have failed. In terms of folly, one of the things that NBFCs probably realized it too late is that risk does not come from the P&L side of the balance sheet. The risk comes from the balance sheet. It doesn't come from the P&L. Unfortunately, all risk managers manage the risk of the P&L very well, because they are looking at the NPA, they are looking at cost of funds, cost of operations, but your real risk comes from the balance sheet side, because NBFCs ultimately live or die at the spigot of liquidity. So what happens is that you have to understand that NBFC is an animal that never ever repays its debt. It only refinances its debt. So if you have a problem where new lenders are hesitating to lend to you, you will by definition have a problem where you will starve of liquidity, and once an NBFC is starved of liquidity, it leads to a demise. So while the end, so for example, the human end comes because of a heart failure. In the end, whatever may have caused it at the start,
The ultimate end will be a liquidity crisis, which could be a part which could have begun because of a credibility crisis or a confidence crisis. But ultimately, you'll die at the spigot of liquidity. The other thing that people don't realize is frauds, and unfortunately, we have had a few escapades on that side. I think lessons have been learned. The regulators also become a lot more proactive, and hopefully, in future we would have a much more stable financial system. So again, it goes back to the point that the now you know that if you die, you'll die out of your own folly.
It's as Buffett says, right? Liquidity is like oxygen. It's when it's there, you don't think about it. When it's not, that's the only thing you think about.
No, also, what Buffett says about the banking business is even more interesting. Where he says that there are two businesses, banking and insurance. In one business, one walks away with the money and the other walks away with the contract. I like the business of insurance because I walk away with the money, the customer walks away with the promise.
Right.
In lending, it's the reverse.
Yeah, it's actually my favorite line when it comes to the lending business is that lending is the one business where every time you make a sale, money leaves the door. It's and actually that line which you said at the start also, which I remember quite clearly in the first conference call of SBFC. In your opening remarks, you said this is a business where the path to hell is a 6-lane highway and there's a narrow path to heaven. But I want to talk about specifically the your experiences lending to small businesses in India over the years, both in your prior life and at SBFC, and what that's taught you about the average Indian entrepreneur. Could you tell me how that section of the economy has evolved over the years, and what has been your overarching sort of opinion of entrepreneurs in that segment?
So when economies transit, they move from agrarian economy to industrial economies. And if you look at what happened in China, they moved about almost 700 million people from agriculture into industry. And unfortunately, when we became independent in 47, we did not have the capital to set up industry. And then there was a bad experiment with socialism, the 5-year plan and the private sector being kept out, and public sector put into infrastructure, nationalized of bank, etc. So somewhere what happened was that opportunities were not available to most Indians, and as they came out of agriculture, there was nothing else they could do. So because of a lack of capital, because of a lack of skill in education, people willy-nilly moved into trade and services. So if you see the migration of people moved in India from agriculture to trade and services. And because of a lack of capital, everybody set up small units, which are small shops, and which is why we created a unique infrastructure in India, which is not there anywhere in the world. We have 64 million small businesses in the country. I mean, this is a number that's a Guinness Book of World Record by itself. No country has so many businesses. So what has happened in India is that every area has its own garage, it'll have its own salon, it'll have its every street corner will have its own kirana shop, it'll have its own chemist shop, it'll have its own eateries, all businesses, where a barber will be there, a tailor will be there, a plumber will be there, a carpenter will be there. Every part of India, in every city, in every corner, you will find these small businesses. So these are subsistence level businesses. These are businesses that are basically taking care of their family. They are not really expanding or growing or seeking capital or seeking deep debt or anything. They are just getting by and bringing the bacon home. So 45,000 rupees a month is generally what they are able to bring home from their business, which is enough. When they own the house they live in, they own the shop they operate from. This is a comfortable existence that they're able to manage. So that's the that's the logic of why we have arrived here. So what happened in India is that big businessmen, very few went into manufacturing. Their big industrial houses came up. They went into manufacturing. They did the big manufacturing, and then you had people who were the baniyas, who became wholesalers, stockists, dealers, and those businesses of MNCs and of other companies. So they, somebody would set up a automobile showroom, somebody would get a dealership of a pump, somebody would get a dealership of a machinery equipment, etc. So people took these dealerships and set up these businesses. Again, those require low capital. That's how our industry has evolved. One of the good things that has happened in the Modi administration is that some basic issues got solved. most Indians didn't have a bank account, and that was the first step to any form of financialization of anything. So the Jan Dhan scheme that came in, we opened about almost 350 million bank accounts, which is a world record again. That ensured that today it's a situation where every Indian has a bank account. That was the first thing. The second is that they introduced what is the first time, because how do you even recognize one business from the other? So here outside, if you go, there'll be a Patel provision store. Now you don't even know if this store really exists and if it's a credible store. And how do I, sitting in Bombay, lend to a customer who's in Ranchi, and has a provision store? I don't even know if it's there or not. So with Udyam registration, that came in, where all these small businesses get registered. At least you are sure that there is a genuine business out there, and it has a registration, it has followed a process, and it is like a known entity, like an Aadhaar. It also has its own identity. So that's one thing. Aadhaar became the next big thing. That for the first time, each individual became identifiable. Otherwise, I would not even know if the same guy I've lent in one state, I may end up lending in another state, and I would not know one from the other. So with Aadhaar, it became lendable. By that time, the individual credit scores started to build, and now there's a reasonable track record of Indians that is available. The FICO equivalent score that we have here, that became available, and therefore each individual now became identifiable and lendable. Their past behavior was identifiable. And then you had various data points that came up with the customer's behavior on the mobile phone. So this Jan Dhan Aadhaar mobile created a stuff. Nilakini's India Stack allowed us to integrate all of this with lending. And then the technology evolvement in terms of building tools, in terms of using AI, ML, to be able to build algorithms where we can take quicker decision making, etc. Became speeded up the process of decision making. So now what happens is that the credit officer becomes more of the gatekeeper and less of the processor. The processing is done by the machines, and because you're looking at two things. You're looking at an individual's ability to borrow and willingness to pay. Ability to borrow can be judged by machines, because it's a mathematical model. Willingness cannot be judged by the machines, so that's where you need that individual coming in. So the qualitative test is the individual, the quantitative test has been outsourced to machines. So that became possible. So if you see what has happened is that of the 64 million businesses, only about 8 to 9% get access to any organized finance. The rest of them are borrowing either from the local money lenders or their own sources or friends and family or stuff like that. Now, also in India, what has evolved is trade credit, where all these small businesses, the wholesalers will give them, and tell them it's 90-day free credit, but there's a 2% cash discount if you pay in cash. So effectively, the fellow is paying a high rate of interest, but he just has no other option. Yeah. So now we are able to give them these options where they are able to borrow and build their business over long cycles. So this business segment is a good segment. The reason why they have not been lent so far is because all these points that I just mentioned were missing. Now that these points have come in, we are able to reasonably assess a borrower. Also on the property side, a lot has changed. Earlier property registrations were extremely weak. Record keeping was weak. Now a lot of states have gone digital. So we are able to see whether the property belongs to the individual, whether it is legal, whether, and Sensei coming in where all charges of properties are created. So, you would have heard of, 10 banks lending against the same property without realizing it. All that cannot happen now. So the system has become safer. What this credit record is doing is that the bad credit is being kept out. Once a CIBIL score is spoiled, nobody lends to that customer. So the bad track record is kept out, and you are rewarding good behavior and punishing bad behavior. So overall, this entire segment has suddenly become lendable, what was not lendable earlier for the lack of the eco infrastructure.
Right. And you were talking about how technology has transformed the space. Your own sort of proprietary software that you guys have, it has a very interesting name. So we're going to talk about the actual use of it, but why did you come up with, how did you come up with the name Leviosa?
So I'm a Harry Potter fan, and the word Leviosa is a spell that is used by Hermione, to lift something up like a feather. So even if something is heavy, when you cast a spell Leviosa, it becomes light. So what we are effectively trying to say is that we have made the process light, because our promise is that we want to make loans easy, and you make easy by lightening the burden on the guy who's taking the loan. I hope he agrees to it, but that was the intention. So the thought process was that when we were designing it, we thought that we'll have to design our own workflow engine. There's nothing that's available in the market which we can use, and therefore we will design our own workflow engine where we will see. Our challenge was that we wanted to make the process digital. We did not want a file on the customer, but unfortunately, the customer was not willing or yet adapted enough to give us documents digitally. So a customer will give us physical documents. We need to convert it into a digital workflow. So our job was that it was complex, that we had to take physical documents and convert it into a digital workflow with us. Also, we do co-origination with ICICI Bank, so there's an API integration with the bank, and the entire file has to flow into the iBank, where their credit buyer can actually see the file, the pictures of the business, the documents, the income documents, the assessments that we have done, the legal reports, the valuation reports, all of that. So the digital workflow was important. So we built this entire application. We designed the workflow. We did about 200 plus API integrations and developed Leviosa, which is a workflow engine that we use. And then everybody works on that, including the originator, including the credit officer who goes, including the credit officer who approves, and including the operations officer who disburses. So everything moves on, and it also ensures that at one place we have a repository of everything. Also, what happens is that we collect about 200 plus data points on every file before dispersal. And these 200 data points are crunched into a score, and based on the score we give grades to customers. So this case, it's between 1 to 5, where we know that 5 is the best customer that we have, which is like almost an auto approved, and then it goes down in that order. So the idea is that we are able to now dimension the risk, and it's a game that we keep playing every quarter, where we keep fine tuning, because you may have thought in a particular way and designed your AI in a particular way, but you may have realized that the score is not behaving as per that. You are getting different defaults coming that you are not accounted for. So you go back, reset the engine, reset the scorecards, and then redo the whole thing to ensure that you are getting the right outcomes. And it's risk ranking, that 5 is giving you the lowest credit cost, and 1 is giving you a higher credit cost. So and then slowly you try to reduce your higher risk business, because ultimately we are in the job of not taking risk. While our job is to take risk, the reward is for not taking risk. So we have to find ways in which we see. I mean, look at what happens. That when you lend to small businesses, you know that 2 to 3% loans will go bad eventually. If 5-6% loans go bad, then you have a problem. Up to 2-3%, you are fine. Now, what all you have to do is to ensure that extra 3 rupees of lending that you shouldn't have done, you shouldn't do. So that type 1 error of credit is what you want to avoid. All this, because see, this is institutional memory. An individual credit officer may take one call, another credit officer may take another call. How do you institutionalize credit? How do you standardize credit? Is by ensuring that the machine, doesn't allow them to make these errors.
Yeah. Leviosa is, of course, I think probably the most famous spell, and there's that famous scene in the movie where it's Leviosa, not Leviosa. But I actually want to talk about something you mentioned, which is this tremendous data that you keep acquiring, either at an individual level or at an aggregate level. And I want to understand how incremental or more information, how that affects your decision making. So obviously having no information prevents you from making a decision, and then there's a sort of incrementally, it's a marginal benefit to have it. And at some point, do you feel that additional information either doesn't make you any better or may potentially make you worse at making a decision?
See, it's exactly like you deciding what you want to do. At anything that you decide what you want to do, you'll sit down and you will list out the pros and cons. You'll want to understand, meet people. You want to understand the laws around something. But at a point of time where the decisions will be taken, the final thing is always a leap of faith. So data only takes you up to a point. And from there, it's a leap of faith. So that is why credit is both a science and an art. That the science part leads you to, it tells you that more the data, better the decision. Because at least you haven't missed any point that could have, because your job is to say no to what has a higher probability of default. You don't know, Credit is not a game where you can guarantee something. It's a game where you pay the probabilities. So you say that whatever is a higher probability of default, I want to avoid that. Whatever is a lower probability of default, that I want to take through. So all the data points that you collect, allows you to reach a point where you can say, okay, now I know that the probability of default is in my tolerance zone. So this case is now qualified for it. After that, whether to then lend or not, there is also final gut feeling. When you meet the customer, there's interaction with the customer, there's a personal discussion that happens. Somewhere there's a gut feeling, and where the credit officer sometimes just tells us that, sir, I'm not comfortable. And that's good enough for us not to do alone. He may not be able to express why. But it's just that he has that experience, he has dealt with people, somewhere he's figured out that I sense, something not right. Sometimes it may be in what he's seeing versus what is on paper. Sometimes it may be in the body language of the borrower. Sometimes it may be over his observations or some ref checks that he has done around. So that is why it's important that data is good, more data welcome, but you also have to realize that in the end, you are dealing with a human being at the other end, and another human being is best positioned to judge that human being, not the machine.
And so gut feeling is actually a really interesting thing to talk about in business, because everybody likes talking about how data driven they are and how, they've tried to eliminate the need for emotion or gut feeling or intuition. But I want to actually talk about that in the context of, this day and age when every company and every person loves talking about technology and how, technology drives the entire business and how focused they are on that. And I want to talk about how in that world, how much of an advantage it is to not be entirely reliant on technology and to focus to at least some extent on the human element of it. And this is maybe slightly broader than just, necessarily lending. So what has been your, in recent times especially, your own thought process on how to ensure that in a world that is so focused on technology, you don't forget age-old lessons of prudence, risk management, and looking at the man opposite you and taking a call on whether he's someone you want to be in bed with?
Banking is probably the oldest profession in the world, and nothing has changed. The way we do things, so the how has changed, the what has not changed. The essence of banking has remained the same, that you borrow from small savers who want to keep some money away and earn some interest on it, and you lend to those people who want to borrow for their business or personal use, and you ensure that the money comes back and you pocket the difference. The basic business hasn't changed since time immemorial. Now what has changed is the speed of doing things has been increased by your ability to automate things. But the same technology is also used by the borrower to outsmart you. So it is not that only you have the technology available. He also has better technology available than you. Now, for example, you see the movies of the 80s where the guy goes with a gun and puts on the cashier and says, "Give me all your money." Now the cashier would say, "No, sir, the easier ways. Have you tried online?" So the ways we rob banks also have now changed. So the reality is that data, and information and all, as much as you can collect, that's good. It helps you go to a better decision making process. But in banking, what is most important is that it is okay if you don't know what you are doing, but it is extremely important to know what you should not be doing. So what is important is that the basic tenets of banking has not changed, that what you don't want to do, that you need to be super clear about, which is in your higher risk quadrant. And that is a function of, because see, what happens is that I can only judge an individual on a short term basis. For example, today, if Krish says, give me 1,000 rupees, I'll give you back tomorrow. I look around the office, I look all around and say, I think that should be fine. I've not heard anything bad about the guy. He's got a lovely office. He's a family man, stable. Comes from good family. My money is safe, and I'll give you the 1,000 rupees. Now, when you say that I want 10 crores, and I'll give you back in 10 years. Now I'm a little careful. Now I'm not going to say, okay, everything is nice, I'll lend. Now I want to know a lot more about Krish before I do that lending. So your hunger for information also, because over 10 years many things can happen. I have to worry about whether the borrower may be around at that point of time. What happens if the borrower dies in between? Do I have the insurance, to cover that loan? I have to worry about that. What happens if the borrower becomes sick and is hospitalized? Then he has other expenditure that the money will go towards. Can I insure him for the health? Also to ensure that that is taken care of. I have to worry about today he's doing this business, but tomorrow that business something may go wrong. Then what will happen? Does he have other sources of income from where he can manage? Are there other people in his family who are earning, who are able to then pay the loan in case he fails? What are the obligations he has? Has he taken loans from multiple people? What are the other obligations? How many family members does he have? Their schooling, education. How is he going to manage all of that? Does he have savings? Etc. How is banking behavior in the past been? So then I ask multiple amount of questions, and then I say, okay, all this I have done, but what if all this also fails? Then can I get some property as a collateral? In case all this doesn't work, then I've at least got something to hold on to in case all this fails. So then I look for either property as a collateral or gold as a collateral or some collateral banks ask for. So ultimately, the basic tenets of the business has remained the same. If you are on the shorter end of lending, you are lending for 3 months, 6 months, then an online digital driven model without meeting the borrower also is probably is fine, because your probability of error is well paid for by the higher interest you charge. But if you are into long tenure lending, you have no choice but to make it a mix of human and machines, because machines have yet not got that smart, and we are far away from generative intelligence, whatever they say.
Right. And so I want to talk about, I'm actually going to talk about you for a second. Anyone who reads the conference calls and, your remarks and your answers and that, and also it's a stream that sort of run through this conversation, which is that there is tremendous candor and almost this sort of self-deprecating humor and, humility that is amply apparent. It's clear to me that it's not, you're not pretending to be someone you're not. How do you think that has affected how your colleagues and peers have viewed you? And not just colleagues and peers, but the broader business ecosystem has viewed someone who has been so open about, what's working, what's not working. Even, for example, in the conference calls, before anyone can even ask you a question, you'll be like, okay, guys, look, something may be higher than it should be because of ABC reason, but don't think that this is going to endlessly continue. And that sort of candor is, unfortunately quite rare in business, especially in public markets. So how important has it been for you to be that person who people can have tremendous faith that, if Aseem Dhru says something, it means that it's going to happen?
See, I think all individuals need to have just 3 qualities. And if they have these 3 qualities, in my opinion, they are well set for life. Teachability, likability, and dependability. If you have these 3 qualities, then you are a human being that others would like doing business with. Because what is important is that, see, none of us know the future. We are only making an attempt to do something. So our intention is clear. We want to build a great business. That doesn't mean that we will actually end up building a great business, because there are many things that can go against it. It is not in my control. The reality is that how much ever I may want to sell it, the reality is that it's not in my control. There are factors, because my dad used to say that for anything to work, Manushya Prayatna, Ishwar Kripa. And net of these 2 things, nothing works. So, if one thing is missing, it doesn't add up. So what is important is that you say Manushya Prayatna will be honest. But Ishwar Kripa I cannot guarantee. That you have to also pray with me. So what is important is that you develop these 3 qualities. One is the teachability. Unfortunately, what happens is that there are many Krishnas, there are many Dronacharyas, there are many Bhishmas, but there are very few Arjuns. What we have to teach ourselves is to be a lifelong Arjun. That you have to be a learner lifelong, because it is important that, unfortunately, what happens is that when education teaches you to read and write, and then we think we are done with it, we do neither after that. Most people forget to both read and write post their education ends, and there is, in the long run, there is no difference between somebody who doesn't read and somebody who cannot read. So it is important that you realize that there is so much in the world to learn from, and what knowledge is not unilinear. Unfortunately, what happens is that if suppose you are a lawyer, you read only about the law, that will not make you a great lawyer. You need to understand a lot more than law. You need to understand society, you need to understand culture, you need to understand religion, you need to understand philosophy, you need to understand banking, you need to understand economy, you need to understand political systems. Unless you understand, the dots will never connect. So it is important that you are a lifelong learner, because what is my biggest problem, is that you at a certain age, you always think that you have done it all, you know it all. But the reality is that patterns may appear similar, but they never repeat. So history rhymes, it never repeats. You can catch a rhyme, but if you bet on it to repeat, you may fail. So it's important that you realize that the world has changed, new things have come. Now, for example, today, I'm spending a lot of my time understanding in this entire field of generative intelligence. I understand so little of it, and I know that this can pass me by. I can just ignore it and move on, but I may miss on something tremendously beautiful if I do not study that enough. So I need to now sit back and understand what this technology is, because otherwise it will just pass me by. So one is that you have to have teachability, that you will lifelong learn through all methods available to you, whether it's by watching YouTube videos, by watching speeches of people, by watching talks, by going through, there's so much content out there. So many of great universities are putting all their content out free now. Courses that you can take to just teach yourself, just for the sake of it. Things that you need to do. So that's one thing. The second, is likability. Because ultimately, people deal with you. People do business with people they like, not with necessarily with people they respect or people they admire. People do business with people they like. So it is important that when you are doing business with people, they should like you. And likability comes from dependability. When they know that they can depend on you, you're not going to take them for a ride. You're not going to tell them something which is not true. You're not going to hoodwink them in some way which is not correct. And you'll be honest. When we started SBFC, Mahesh and I used to tell ourselves that we may not be the prettiest company on the planet, but we certainly want to be the most honest company on the planet. And in a country where trust is at a deficit, you always get premium for honesty. So what is important is that my investor, may worry, whether my performance is on track or not, but he shouldn't worry whether the numbers he's seeing are correct or not. So that's the only promise I can make, that we'll work hard, we'll be truthful, but that's all. Whether we will be able to deliver the goods and somebody may do better than us, that's not in our control. But we will work hard. We are sincere people, but we may not be the smartest guys on the planet, but we'll certainly try to be the cleanest guys on it.
Are you a student of the Mahabharata?
So it has influenced my. So I've read a lot of religion, almost everything that's out there. I've consumed in some format or the other. There are parts of the Gita that I've internalized in a very big way. There are parts of the Dhammapad that I've internalized in a very big way. There are parts of Mahavir that I've internalized in a very big way. So I've been, but the Bhagavad Gita, if there were to be one manual of living life, that's it.
And do you, from either the Gita or the Mahabharata or actually any other religious, quasi-religious book, is there a favorite? Do you have any favorite story or lesson, or maybe even one or two that sort of have really either guided you when you needed it, or just generally been a principle with which you've lived your life?
One of the most touching scenes of the Mahabharata is when Krishna goes to Duryodhan and says that this war needs to be avoided and it's going to lead to mutual annihilation. Nobody will get anything out of it, and you should not go for the war. And he launches himself into a lecture on dharma and what is right, etc. And Duryodhan stops him midway and says, "Janami dharmam, na cha me pravrutti. Janami adharma, na cha me nivrutti." So what he says that I know what is right, but I'm unable to do it. And I know what is wrong, but I'm unable to stop myself from doing it. And that is the human predicament. All of us at all points of time know what is right. But doing what is right is character. And all of us know what is wrong, but we still end up doing it. Not doing what is wrong is character. Because what happens is we live on three levels. The human being lives at the level of the body, the mind, and the intellect. We have three lives. We don't realize that. The body experiences pain and pleasure. The mind experiences gain and loss. And the intellect, the ego, experiences victory and defeat. Now what happens is that generally anything that is long-term bad ends up being short-term pleasurable. And your body says, I want it now, it's pleasurable. I know the doctor has told me there's diabetes, I shouldn't be touching the sugar, but this is too good to be ignored. At least one I can have. What's the problem? I'll walk tomorrow 1 kilometer more, but I'll have this rasgulla. Now this is your body telling you go for it. The mind is telling you don't. It's not good for you. So look at the conflict. There's a Mahabharata in you even on such small things. There's a constant war, happening. Now who wins the war? The guy who wins the war is whose Sarthi is Krishna. We have 5 senses. So in the Mahabharata, the Arjun is the body. The Rath, it's not about this. Look at it this way. It's not about philosophy or anything. It is about saying Arjun is the body. The Rath is the body. Arjun is the individual. The Rath is the body. And the 5 horses are the 5 senses that we have. So the senses are in the hands of Krishna in terms of Arjun. So he's guiding the body right. He's controlling the senses. So ultimately, if you see what is the level of mind you need to create, it says Sukha Dukhe Same Krutva Labha Labho Jaya Jayo Tato Yuddhaya Yujjasva Naivam Papam Vapsasi. So what Krishna tells is that create a mind that is equanimous. So there is one thing I've taken from the Gita, it is equanimity. That create a mind that is equanimous, not disturbed, not agitated, not excited. By what? By Sukha Dukh at the level of body. Labh Alabh at the level of the mind. Jaya Jayo at the level of the intellect. So create a mind that is equanimous, that doesn't get disturbed. Now, if you come to Buddhism, the Dhammapad, there Buddha talks about anicca, saying that everything is impermanent, transient, nothing is permanent. Today you are feeling good, this too shall pass. Today you are feeling low, this too shall pass. Today people are praising you, this too shall pass. Today people are criticizing you, this too shall pass. There is nothing permanent in the world, don't get attached. So the third principle is Mahavir's aparigraha, where he says no attachments towards anything. You don't get attached to the chair, you are a temporary occupant, it's not permanent, it's not yours. Someday somebody else will sit on it. So the point is that you realize that everything in life is temporary. It is the Patek Philippe ad, if you recollect, which says that you never really own a Patek Philippe. You only take care of it for the next generation. So you realize that there are 2 ways to look at what you are doing. So at SBFC, there are 2 ways you can look at it. ये जागीर है या ये अमानत है. If you say ये जागीर है, then the ego comes in saying this is my fiefdom. This is what I do. This is what I control. What I say happens. This is my property. When you say amanat, that means I'm taking care it for somebody else. I'm just a mere caretaker. That's the principle of trusteeship, that gets talked about in business. That you are a mere trustee. You are holding it on behalf of a lot of participants. There are banks who have lent to us. They have trusted us. We are responsible to them. There are investors who have trusted us. We are responsible to them. There are small shareholders who have trusted us. We are responsible to them. So you know that you are merely a trustee. As a trustee, you only have accountability and responsibility. There is no perks of the job. There are responsibilities of the job. And as long as you stay focused on this and you realize that you create a mind that is equanimous, Gita, you create an intellect which understands anicca, that everything is temporary and will pass, and you create an ego which says aparigraha, nothing is mine. Then you have because what is the purpose of life is joy. If in doing all this, if you lose sight of that joy, then what is the point of living at all? So what is important is that when the only way you can sleep is with a clean conscience, when you're hiding nothing, and what is worth it if your sleep is disturbed. So what is important is that you do the best you can, but you know that it's not in your control. The outcome is not in your control. The effort is, you focus on the effort. Ultimately, it is karmanneva adhikaraste ma phaleshu kadachana, which is the truth. That human being can only act in the way in which he best can. The results are not in your hands.
Yeah, it's absolutely fascinating. I mean, listening to you, and when I read the Mahabharata, not just the Gita, and you realize how many unbelievable lessons there are. And one of my biggest takeaways from that was this idea that we're taught when we're young, that there is very clearly a good and a bad in life. And when you actually live life, you realize how much of it is grey, right? And there's this incredible scene when they're asking Bhishma sort of on the bed of arrows, and they're asking him lots of questions on life. And he talks, and this is someone who's seen as a beacon of, goodness and virtue in the world. And he talks about, when is it okay to lie? Like, he lists out a number of places where it is almost you are supposed to lie. But I take your point that there is so much to learn from so many different sources. That just because you're in one particular field doesn't mean you have to spend your entire life focused just on that. I want to actually end by again talking about you. a common thing that people, when they're naming their children, they focus on the first name, right? They want the name to mean something, and in some way, in the hope that giving him or her that name will make him or her that way. Yours is a somewhat unique, I mean, not a rare case where the last name actually in some ways has a deeper meaning than, say, the first name, which is quite rare because generally it's the first name that has real meaning. And so Dhru, I think it has multiple meanings, but the most common usage is essentially a word for being steadfast and not moving when there's a force applied on you. So I want to ask you about how important it has been in your life, especially professionally, that you are steadfast, that when a challenge presents itself, you don't buckle under pressure, and there's pressure in all sorts of forms that come over time. So how important has it been to be steadfast to achieve whatever success you have achieved in life?
So actually, if you take the first name and the second name into account, then it becomes even more interesting, because the first name means one who has no boundaries, limitless, when jiski koi seema nahi, and the second name means steadfast. Now, what is important in life, actually, is that you need to be steadfast on your values, but fluid on the means. Because ultimately, you will not be able to achieve anything exactly the way you had designed for it. Because world changes, the things change, as situations change, circumstances change. So you have to constantly adapt to the changing circumstances. But the basic right and wrong, good and bad, never changes. They are timeless. So what is ultimately important is to realize that if you cannot, when you're building something, or with any activity, you cannot lose sight of what is the most important thing to you. And ultimately, see, let's look at two truths. What is the name of your great grandfather? None of us know. The reality is that our own 2 generations later, we won't even be remembered. We will be forgotten. That is the reality. And no matter what you have done, ultimately, it's all lost. So we are here temporarily, shan bangur, as they call it in Sanskrit. Our life is like a bubble. Here one moment, pop the next, and that's all there is. So all your life, what is that one currency that you really earn? That's your reputation. And ultimately, it is about this, that you may lose all your money, you may lose all your wealth, you may lose all your power, but never lose your reputation. If you have kept your reputation intact at the end of a banking career, I think that is the greatest gift you can give yourself.
Absolutely. I that's one sentiment that's been echoed with every banker I've had on the show, is nothing is more important than your sleep, nothing is more important than your reputation. And you see the ones that have really succeeded, have done incredible things. That is maybe the one overarching commonality among them, that they had that focus on always doing the right thing and thinking of the longer term impact of having the right reputation. But Aseem bhai, thank you so much for coming on. It was absolutely wonderful having you on and talking about a wide range of things. I hope you enjoyed it as much as I did.
Thank you for having me. I hope it was helpful.
Absolutely. Thank you.